Hello and welcome to the Harwood Report for December 4th, 2018. I'm Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are for educational and information purposes only and should not be considered investment advice. Please read through the rest of these disclosures, and then I'm going to talk to you guys a little bit about the charts and where I think things are heading. Alrighty. So, the big things for me, yesterday it was all about equities and a little bit about the VIX. Today it's a lot about bonds and commodities. Kind of a different feel today than we had yesterday. So let's go first off to fear and greed. Fear and greed's now at 30, so it is starting to come back up. You see, one of the big things that happened yesterday was really this big shift from trading puts to trading calls. So people aren't hedging by buying puts. You had a little bit of activity yesterday selling calls because we pushed the VIX down, but we also saw some buyers of calls, people looking for a little bit of momentum. So I think that what we're dealing with right now is a little bit of a balancing act, a little bit further rally, and we'll see more activity on the call side with sellers. Maybe then we'll start seeing some put spread trades and things like that. And then if the VIX can actually get low enough, to that like kind of 12, 13, maybe even 11 range, who knows how low we can go, then I think that we can be starting to set up for, a new high followed by a potential for a pullback again if things change again on the fundamentals with China and they get worse. You can see the VIX is below its 50-day moving average. That doesn't matter as much to me. I'll show you what I believe matters on that when I get to the charts. Difference in stock and bond returns. There's no difference. They are unchanged. This is not necessarily fear. I'd say that's neutral. This is still showing a lot of fear. This is not fear. This is extreme fear to me. I get it. We're not showing the October kind of dip, but we are showing some serious weakness overall by having many, many more stocks hitting 52-week lows and highs. If this starts to climb back up towards zero, that's a really good sign that this market has found its floor, found its footing, and we don't need to have that panic falling knife reaction in all these individual names, because there's a lot of individual names who've basically acted like a falling knife while the indices got held up a little bit by some of the better performers that then started to roll over. Things like Apple and a lot of the big tech names. This means nothing ever. Summation volume, this is very similar to the 52-week high and low stuff. The breadth is still needing to come back up. And then finally, market momentum. We are back basically testing this previous high. I'll show you that more on the chart here specifically because that's easier to see here. We're basically testing this level. We're getting real close to it, this 280, 281 level. This is a big one. We had a double top. If we get back up there, that creates a potential for a triple top right at the same marker as the 100-day moving average. So we've got a really clean technical level to trade against from the bull side. If we can clear 281, the high here, and then basically push that little extra bit, 281.20 to get above the 100-day moving average, I think people are going to start saying all clear, 291 is right there in the view. Okay? I think there's going to be a battle here. So what does that mean? It means that we look for a structure in the options that gets us a $3 to $4 rally followed by a week-long battle. That also should mean the longer that battle lasts, the more likely we go higher, because I would expect to see the VIX drop. So as the VIX drops, people get more confident. The inputs to their model say there's less fear, less need to sell, less need to hedge. Let's go back and put the normal money flow from our 401ks and our other, basically income that we can put back into the stock market. And that helps press the VIX lower, and then it becomes a sort of repeating cycle. The market goes higher, so the VIX goes lower. The VIX goes lower, so the market goes higher. We grind it out, and the VIX can get down here towards 13. We start repeating what we did in the summer. Maybe we get a dip in the market with a little bit in VIX a couple times here or there, but we're not looking at this stuff anymore. I think we're starting to get away from all of this stuff, especially if this China deal does come to fruition. Tech was our big leader. Had the big move yesterday. Closed right at that 200-day moving average. A little weak today. Here's the big tell for me in tech. Uh-oh, SMH, not loading for me. Let's try one more time. There we go. SMH. So SMH had been generally relatively weak. It is still well below the 200-day moving average, but you can see that it had better performance earlier before this rally, and then now it's pulling back more aggressively than the Qs. So this is the sector to watch for me. If this confirm, then it does tell us more about confidence that tech is fine and the China deal is good. IWM was strong relative to the Qs when we came out of February. It started off a little strong, and then yesterday it was weak relative to everything, and today it's weak again. So we have to watch this as well. So my two big tells on the market are going to be really small caps, IWM, and semiconductors, SMH, because those were the two weak ones that started the crash, and if they can lead us out of it, we're going to get that much more confidence in the market, because these are the names that had a lot of stuff hitting 52-week lows prior to the rest of the market, or hitting their lows before we pulled down everything else. So keep an eye on those two sectors. The other thing that I think is big today is what's going on with like bonds, dollar, all this other stuff. So you see TLT spiked. Big move in bonds. Looks like people are expecting less chance of rate hikes in 2019. Great. So that's actually kind of nice, because what that does is it starts pushing people back into that, well, maybe there is no alternative again. So that also helps the stock market. We go to the dollar. I don't see there's a good trade there, so that's why I'm not going to focus on it right now, because it's it's kind of a spike after a big fade. Dollar is starting to weaken though, so this is the one I want to focus on more. The dollar is just starting to show its weakness. It did bounce back today after a really weak start to the day. We know dollar yen was very weak this morning, and still is weak, and it's starting to look like gold and silver and all those precious metals are going to start getting a little more bullish here. And you can see that we're really pressing towards the highs. Yesterday it looked like gold and silver really wanted to roll over, and then one day later it looks like they want to rally. So we're still shopping in these things, but I think a hedged long in gold and a hedged long in silver can generate some real return potential here. Note that we're really testing getting close to this real chop zone we had in silver, but we're also getting really close to that 100-day moving average. If we can get a close above the 100-day moving average, which we haven't done since the collapse here in June, I think that's a big tell. You start to see some of these slopes turning up in the 10, 20, and 50-day moving averages. Things are starting to look a little better on the commodity side. Again, if you want the option strategies associated with this, you got to sign up for the premium product. But I want to show you guys where I'm thinking about, how I'm thinking about structuring some stuff here. Oil had been in absolutely terrible shape. Today, it's not moving much. Part of that, I think, is because, frankly, people are just so tired of bounces being faded. And so some of these bulls might just be taking their, well, we got to bounce, I'm just getting out mode. That's a good setup for the bull overall, especially if the dollar is going to stay weak. That then sets up XLE and OIH for really good potential. And I talked about how I would be playing XLE and how I'd be playing OIH in the premium product. Basically looking for some of this move back towards this consolidation area. And there's ways to play it with the options that get some really big leverage, even though options are expensive right now. And so I mentioned the premium product. That's the Hardwood Report. It's $49 a month. And if you sign up right now, you get the first week for free. So you get a week to test it out, take a look at the product, and say, okay, cool, there's some interesting stuff here. I want to continue on. And if you don't, no harm. You just cancel, and we move on. So sign up for that now. You get this information that I'm telling you now a day earlier in the newsletter. And then there's also a midweek update video that I put out for premium for subscribers only. Email me, keith@tradeacademy.co if you have any comments or questions. And we will talk to you after tomorrow's day off in the markets with the midweek update for premium subscribers. Thanks again, folks. Have a great rest of your day.